The Bulls versus the Bears. Get in the game. www.tackletrading.com.
Hello, everybody. This is Coach D with TackleTrading.com, here to give you a quick market update and recap for Tuesday, August 4th, 2015. Market's still continuing sideways in general. We're in a bit of a consolidation pattern here. We're looking at the E-mini S&P futures, and we've seen where the market's kind of, gone up, test resistance, came down, tested support, kind of whipsawing in here, and we're actually having a consolidation symmetrical triangle. So if you see that inside type scenario, you see if we change scale and go back into like a weekly time frame, this is what creates Harami style patterns. So if we go into a weekly time frame, you'll see the candlesticks in here will be Harami-esque inside candles. And that's one of the things you want to take from this little comment right here, is that an inside consolidation is what would give you a Harami style candlestick. So here's a Harami, not quite, but ballpark. It's just consolidating inside, which means this isn't sure whether it's coming or going. Based off of the time of year, August, heading into September, October, would not be surprised to see a market correction depending on the forecast for the fourth quarter, depending on what we see the Feds do. We got some potential for raises in interest rates. We see that they've got some watching for the labor force is what the basic holdup is. Fed saying they want to raise interest rates, but they're not in a hurry, that the labor force is more important, was what they came out with on their statement. And that was last week. This week, the only real major economic news is the non-farms payroll report and the unemployment report. And we all know that those can be big. Those can move the currency. We got some of that coming out, preliminaries on Thursday, and the big stuff coming out. So keep an eye on that economic calendar. Again, as always, we want to keep our finger on the pulse of the market. So here we see that S&P kind of inside. Some of the sectors are very bullish. Some of the sectors are very, bearish. And I would probably say, I'm not sure which way this thing is heading, but whichever way it does move, these are pretty formidable support resistance zones. And if the first support resistance zones start to break, it won't be surprising to see it come down and kind of test that 2000 zone, pretty hard. If it breaks to the upside, I'd expect it to be a little bit more tentative. I don't know if we'll get huge runs. But again, nice thing about being a trader is you don't have to predict the future. You just have to anticipate movement and anticipate it. With directional, this can be harder. Waiting for it to confirm, break, support, or resistance. We never know how much it's going to move. We just know that it should move. Keep in mind, consolidation leads to breakout. This is what we might refer to as a squeeze, where if I were to throw on, say, some indicators like a Bollinger Band or some Keltner channels or some envelope type systems, you can see where the data is squeezing inside. We're just seeing this sideways movement. We're really no further ahead today than we were back at the beginning of the year. So, in fact, we actually are back at where we closed the year out in December. So that's the S&P. NASDAQ/NQ is trading up above its own resistance, kind of came in, put in a higher low, and seems to be running out of gas and consolidating. And this is going to be interesting to see which way it goes. Obviously, it can go either way. This could be kind of a break retest of its own zone, and if it holds, we could see it run. The Dow, let's go with the Dow YM, and you'll see here that that's got a lower high and a lot more bearish look to it. Actually putting in the lower high, coming down towards that support. You can see heads and shoulders or inverted cups and handles on that. But still inside of the overall sideways range. And then finally, the Russell 2000 as well. So, boom. We see that as well. Okay, here's the Russell. And okay, so we take a look at the Russell 2000 here. You can see it also is put in a lower low, and it's giving a bit of a lower high. Not real downward movement like we see in the Dow, but inside consolidation for sure. Lower highs could certainly give it that feeling of a kiss goodbye type setup. Could see some downward movement, into that bigger support zone. That 1200 is going to be a big number for the Russell. In that ballpark, down 1200 to 1180 or so, it's going to find some significant support, and that puts it also shorter term swing range down into that neighborhood. So, if we see a recovery breakout off of the jobs report, it'll be interesting to see. This is the time of year where your institutions are looking to determine whether they're going to be, in this thing for the fourth quarter based off what they think retail and economy is going to be doing versus not. And so if they think that this is going to be a harder year, they might be a little bit more tentative. One of the things we can make sure we go look at and understand here, let's go open up Shiller PE ratio. If you're not familiar with the Shiller PE ratio, it's definitely been one of those things I think I've written a article or two about. And the Shiller PE ratio, I'm just Googling it here real quick. It is currently at 26.54. So what that means is that the PE ratio on all the S&P 500 stocks, the actual price to earnings ratio, is higher than it has historically been. So we've seen it higher on a couple of occasions. We've seen it higher on Black Tuesday when the markets crashed before the Great Depression, 1929. Boom. We saw it get up into this ballpark and stay out in that ballpark during the 60s and 70s a little bit. Black Monday in 1987 wasn't even that high. Black Monday was only in the, not even 26 down here, a little bit closer to, let's see, I'd say we're down in the 15 range on that. And then the dot-com boom's the highest it's ever been out there, like 43, 44, really quite up there. So the current data at 26 is exactly as high as it was back in 2007. Now, it stayed in that neighborhood for years before 2007 and 8, but that price to earnings ratio right now is in a zone where I'd considered on the higher end. And so just knowing that the price to earning ratio is up above areas where historically it has been preceding corrections in the market, just something to be concerned about. Or not concerned about, aware of would be the better way of stating it. So awareness is what we want to see on that. Let's take a moment and look at the sectors and industry groups so we can get a feel for what's going on with sectors and industry groups. So here we've got the energy sector just getting crushed. I definitely maintain bearish postures on the energy sector, breaking key support zones, testing all-time lows. If you look at oil, a similar situation. Basic materials, this is where we kind of pulled off some of our trades on the ETFs here. Nice little bearish move. Clearly have some random drawings on there from whatever I was doing. Let's go ahead and clean that up and kind of zoom in. It held a little bit of ground today, so it's kind of got an inside, I'd say, good bearish kiss goodbye setup, dropped confirmation, hanging out inside. Whether or not this is heading up or down, we'll have to wait and see. I won't be surprised to see it heading. I'd be surprised to see it heading up. But if it clears that, we got stop losses and things on that. These are some of the ones we talked about in the scouting report. I'll come back and look at those. XLI industrial, same thing. Broke down key support level, lower high. Industrial's not looking so hot. Tech sector's good, consolidating inside. It's consolidating inside, and we're seeing some movement there. The utilities actually coming in and breaking a resistance point. So the utilities breaking up, but still in an overall trend where there's a kind of a ballpark trend zone in here that you might not spot, but you kind of got channel resistance in here, known support resistance from previous ballparks around 45. Range up, boom, but higher low, higher high could be a signal of change for the utilities. Energy costs are down, heating oil and that, things, nat gas, things like that are down, so that could actually lead to some profitability for utility companies. Let's keep an eye on that. XLF, the financials have been among the stronger sectors, and the financial sectors here, testing up near resistance, kind of mid-channel, and it's out near previous highs, and it's come off of recent all-time highs. So if I'm going to be bullish, financial sector is one of the places I don't mind doing it. The consumer staples and consumer cyclicals have been the strongest. So that's actually where I feel most comfortable going bullish is these last three here. Consumer staples, it's breaking out. This would be, again, the stuff you need to buy and buy anyway. The consumer cyclicals, stuff you don't always buy, is actually running really strong. And then the healthcare, XLV, is stronger mid-channel, just kind of like the other one, but it's pressing higher lows, higher highs, and I think it's got upside potential if the market is going to continue to press up. Let's jump in, and I want to get back into where we were talking about the scouting report. And I did the scouting report this week. Great opportunity to take over that while Gino was out of town, up in the mountains, getting his manliness and wood chopping and fire starting merit badges renewed, I suppose. But let me jump in here and talk about some of the trades we put in, and had a really just great start for that. Um, for the bullish team, we had Home Depot. That would be your kind of consumer staples and and cyclicals kind of combined. Your retailer. Celgene was a bullish one from the healthcare biotech sector, and then IYR real estate is a back ratio. I took a little bit different trade on that, but we can go in and look at those real quick here. So let's go look at starting out with the Home Depot. And Home Depot is actually still a good trade if we haven't pressed it. It's still actually at a point where it can trigger. Haven't triggered in because we were looking for it to take out the high, but we actually now have a retest and a bullish candle, and I'd be looking to trigger in above these highs, probably 118 and change if you want to go for a trigger. I'd be good anywhere above today's candle or even that previous day's candle. I'd probably take an intraday to go pick my trigger on that. But if you haven't triggered into Home Depot and we see market moving up, I'd be looking to get into that trade probably prior to. I wouldn't go in any time after Wednesday or Thursday, just because it's towards the end of the week, depending on what you're trying to do directionally. So then I would go and let's look at Celgene. And Celgene's still waiting for confirmation as well. Now, Celgene had a nice earnings report. Boom, pops, runs, retraces into a known support resistance zone. Hasn't triggered yet. So if you kind of look at where we say we have our trigger on Celgene, it's still an opportunity for us. So we're looking to trigger in at 133.75. And we have not gone out above that yet. So 133, I'd probably adjust my trigger down now to about 132.57. Ballpark, 132.70, wherever you're in that, anywhere you can lower that because it's gotten some consolidation. What I'm not seeing in here is any increase in volume, and I usually like to see a spike in volume at a support zone. We can see that we had good spike on earnings, strong run. Tapering volume is a good sign, but I like to see an increase in energy. Sometimes you don't get that until it confirms, but certainly possible. And then IYR was a back ratio, which was not really contingent on confirmation because the trade is forgiving if it goes the wrong way. But it's still a plausible trade setup where what we did is we sold in the money options down here, I want to say around 72 in the money calls, and turned around and bought out of the money options with the premium. And the reason we don't have to wait for confirmation on this is if it runs up, we win. If it runs down, we don't lose. If it gets stuck in the middle, that's where we run into problems. Now, if real estate, I'd say probably runs if interest rates stay low, and we will probably see some continued consumption on that. A lot of markets have low inventory, where the economic slowdown led to a real decrease in available inventory. But seasonally, we look for a spike in the real estate, come August, September, because that's when people again move. They move the most in spring and fall. Let's look at the Bear Team, XLB and XLE, and Caterpillar and Target. Now, these were very, very good technical setups as far as the XLB goes. We looked at that one already, but it's got a nice confirmation down, and we simply don't want to let it reverse on it. We've got our stop out here. You could adjust that if you're looking to, for that, but I'm watching to see if it's going to break down. This is where I would take it intraday here and kind of look at it from let's go break it down into a, say, 15-minute time frame. And what we'd be looking for is downward movement. We want to see a reversal here. Let me take it to 30 minutes, see if we can clean that up a little bit. Okay, what we're after is that lower high. So it's the breakdown, boom, and we're kind of looking for a kiss goodbye. So here's the support zone, and we're looking for some more downward movement. So far it's looking good because it gave up its highs for the day, and in general I'd say it took back a little bit of volume on the down, not too bad, kind of not sure whether it's coming or going. So I'm still looking for downward movement, and I'd maintain the same targets, look to take profits after you get another one ATR drop. Something along those lines would be great. XLE, the energy sector, has been getting crushed. And we had our triggers in there, and it's confirmed down for us and continuing to head the right direction. Targeting down around 65. Watch for slowdown, watch for reversals, but we're starting to see it continue in that direction. And again, if you nailed it on the trade, you got in, great. It's running the right direction. If you got profits, don't hesitate to log in, scale them out, adjust the trade. TGT is kind of a fresh kiss goodbye. We're also kind of rocking this trade as well. Boom, boom, confirmation down yesterday. Before hopefully you got in on that. Still downward movement. Got to keep in mind that it will be sensitive to jobs report, and really kind of hoping to see it can come down in, and it's at a support resistance zone. So we got to be leery of reversal on that. So it just stops to break even for sure, and then we look for some continued downward movement. And then the Apple trade was basically just a spread trade and credit spread, and it's been doing just great. Haven't seen anything crazy with that because it came down, tested. If you needed to adjust, great. Breaking that support zone. This is a big support zone. If it forces you into rolling the trade, we're above our strike price, so it's not, you're feeling a little bit of pain on that probably. Hopefully your position sizing appropriately. If that is the case, your general strategy at this point in time, I don't roll the trade. I don't hedge the trade at this point in time because it's already ranged down into support. If I decide I need to roll it, I'm watching to see if it's going to give me a rally in here. And if you do need to roll it, what you do is you buy back your short position, take the loss, roll down out further strike prices out in time. Because this is a pretty solid support resistance zone, keeping an eye on it. Plus, it does pay a dividend, so that we might watch to see if people dump it post dividend. But I'm not overly concerned about it. If it does continue down, break this zone, you could break a leg on the option, short sell the stock, buy puts, alter the outcome. You could also lock in your profits on the top, roll those down if you need to. Sometimes I'll roll down the whole thing, the whole condor, take the profits from the top, and roll the whole thing down and out if needed. So that's our options report. Pretty good week for us. Not too bad, not too shabby. This is Coach D with TackleTrading.com. Look forward to seeing you guys in the clubhouse, and we'll see you on the Coaches Show today.
Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.